Real estate investing is like playing the most complicated game in Monopoly you could play, except the board moves, the rules change, and you're playing with real capital and ultimately real consequences.
Taylor is the direction of acquisitions at Low Property Group. And over the past decade, he's helped deploy 1.7 billion plus of capital into multifamily acquisitions. I'm incredibly excited to talk with you today, Taylor.
In this episode, we break down how real estate deals are sourced, underwritten, capitalized, and exited, and why one wrong assumption can cost millions.
So Taylor's mistake on a 3% miss on rent growth translates to a $3 million miss on value.
Real estate private equity is a game of asymmetric risk. Markets shift, interest rates spike, and the investors who win prepare before the deal ever hits the market.
In my opinion, deals aren't necessarily found, they're prepared for.
If you want to understand how wealth is built in private markets, this conversation is essential. Welcome to Wall Street Mastermind.
And so I'm Max Adams, the head coach of Wall Street Mastermind. Today I'm speaking with Taylor. He's someone who's quietly shaping the skyline of Utah, one acquisition at a time. And so Taylor is the direction of acquisitions at Low Property Group, where he's focused on fundraising, sourcing, execution of high-growth multifamily mixed-use investments. And so this is one of the fastest growing regions in the country. It's part of why he picked that. And over the past decade, he's helped to deploy 1.7 billion plus of capital into multifamily acquisitions, overseeing $500 million of dispositions, and playing a key role in managing a multi-billion-dollar portfolio, climbing from analyst up to director at a pretty astonishing rate. And so before Low, he was vice president at Bridge Investment Group, where he built a reputation for scaling value-add strategies nationwide as well. So BYU finance grad, rose from analyst director, like I said, at an incredible pace, has done billions of dollars of deals. He's got an incredible background here and an incredible insight into the world of real estate investing. And so I'm incredibly excited to talk with you today, Taylor, pick this apart and understand what it looks like on the inside. So Taylor, welcome to the show.
Hey, Max, you're too kind. I just want to start off, thank you so much for setting this up. It's something I wish I had, when I was a student. And just kudos to you for building this platform and kind of giving back to students. This is great.
It's kind of you to say, And I'm just so excited to dig into this because real estate investing, honestly, it's one of the most interesting areas of finance for a lot of our students. But there's not as many resources out there as traditional M&A or private equity paths or something. And so it's this very opaque and dense world where there's a lot of money to be made, a lot of real impact to be had, but there's not a lot of material out there. And so Let's dig in. And I want to start with the basics of real estate investing just to make sure everyone's on the same page about what this is and how it works. So you've worked on $1 billion plus of real estate deals. What does the real estate investing world actually look like? What are the categories within real estate investing?
Yeah, you're right. It's very niche. So to simplify it, I would just say real estate investing is like playing the most complicated game in Monopoly you could play, except the board moves, the rules change, and you're playing with real capital and ultimately real consequences. And maybe later on in the show, we can kind of run through some of my experiences and the consequences that I faced. But simplifying it down, real estate, it's just allocating capital to physical or tangible assets with the intent to generate predictable cash flow and benefit off of long-term appreciation. So that's probably to the point what it is, the basic. As far as the different strategies, people don't understand real estate is a spectrum of opportunities career-wise. So there's development, acquisitions, asset management, capital raising. You can go in and become a lender or be part of a credit facility. So I think that's something coming out of college I didn't quite understand. There's a full range of opportunities going out into the professional world.
Mm-hmm. Gotcha. Okay, well, give us one or two sentences on each of those different investment strategies. So you mentioned development, acquisitions, asset management, capital markets, credit investing, sales and brokerage. This is a bunch of different stuff that real estate investing can be broken into. What's the 1 to 2 sentence definition of each of those, just so we can get on the same page?
Yeah, so development, it sounds like how the word is. Development is building things. Acquisitions, recapitalizing, repositioning, That's essentially buying or selling or working with different capital partners to buy, sell, or reposition existing assets.
Hmm.
Asset management is operating or managing assets. Capital markets is fundraising to go buy, build, or develop assets.
Hmm.
Credit lending, I think that's pretty straightforward. As part of the capital stack, a large portion of that is, in most cases, debt. So you're working with teams to place that debt. And then the last one that I didn't mention is brokerage sales. So with every transaction, there's an intermediary, and there's thousands of individuals nationwide that work in a sales position to ensure those transactions,
Hmm.
happen seamlessly. So
That's super, super helpful. And like when I first started looking at real estate investing, not that I'm by any means an expert, but have done a little bit of stuff on the side. Like I wish I'd had it broken out that clearly for me in terms of like what the different areas are you can play, because there's so many different opportunities to invest in real estate and 10 different strategies. But what also makes it complicated, and I love your monopoly analogy, is that not only are there different like types of investment strategy, but there's also different roles in the capital stack. And so walk us through what are the most like capital stack roles, all the way from like, the most junior debt up to equity. Like what does that look like, and where do you think is interesting in real estate investing?
yeah, so when structuring a deal, uh, there's certain layers to the stack, right? And it's ordered in priority to who gets paid first. So
Hmm.
top of the stack obviously is your senior lender, or your
Hmm.
primary loan on the deal. And between that, there's mezzanine debt and a hybrid of both debt and equity, which we call preferred equity.
Hmm.
And in the last bottom portion of the stack that gets paid last, and this is kind of the space that I play in, is
Hmm.
common equity. And ultimately, when you're part of the common equity in the stack, you're the true
Hmm.
ownership layer. You get paid first, and you're really capitalizing the most or capturing the most opportunity in investing in a deal.
Yeah. So you're the last one to get paid, but like when things go well, you do well.
They go, yeah,
And so,
exactly.
so I think it's a classic risk reward spectrum that I've seen on the private equity side that you're playing about in the real estate side, where it's like, what is your risk tolerance? What is your return threshold that you're looking for? Uh, but before we get into that specifically, we have to talk about the different asset classes too, because to add to another layer of complexity here, not only are there different strategies and different like roles in the capital stack, but there's also very, very distinct asset classes within real estate. And so like walk us through what are the different types of real estate asset classes that you could invest using one of these different strategies or tranches of capital.
Exactly. Yeah. So think of it different ice cream flavors. Typically, when you choose a career in real estate finance, you pick a path or an asset class that you're working on and you specialize in.
Hmm.
So the first of many is multifamily. That's what I've been spending the last 10 years of my life focused on. So
Hmm.
multifamily is just think of it apartments or where people live.
Yeah.
The second asset class is office, where people work. The third is retail. That's where things are sold, bought. Think of like shopping centers,
Hmm.
restaurants. Industrial is the fourth. So think of warehouses or net lease buildings,
Hmm.
logistics. The fifth is hospitality. So hotels, leisure, where you're spending time on vacation. That's kind of in the hospitality bucket. And
Hmm.
then there's a full spectrum of kind of niche specialty use. So student
Hmm.
housing, senior housing, data centers, they kind of fit in this kind of doesn't fit anything
Yeah.
category. And that's kind of the last of the seven. So.
Fair enough. Yeah. Although data centers, I feel like I've heard so much about in the last few months alone, which I'm sure we're going to have a great discussion at some point in here on AI and the impact that it's
Yep.
having on the real estate market. But we'll come back to that one. Now, the last thing that I want to talk about with regard to real estate investing, because this has been an incredible primer already, is the different risk profiles. So I know that there's like some specific real estate terminology around like the degrees of risk that a real estate deal has. And so what are those common like terms, and like what should we expect in terms of risk profile characterization?
Yeah, like in any investment, there's a balance of risk reward, right? So in real estate, we categorize them based off of, call it, four different tiers. The top tier, which is, the most or the least risky, is called a core asset. They're typically stabilized, newer vintage. You pursue them with lower leverage, and ultimately there's lower risk. The second is core plus. So the first, but just add a plus sign behind it. It's stabilized, and ultimately you're adding a light value add or a light lift onto that investment. And the third is a value add strategy. So you're going in and it's more of a heavy lift. You're repositioning the asset, whether that be pertaining to the physical part of the asset, improving interiors, improving exteriors to drive rents, or maybe there's an operational inefficiency that you're capitalizing. Current management isn't doing their job right. That would also be categorized in a value add risk profile. The fourth is the most risky, and that's the opportunistic bucket. And within that, we typically characterize ground up development as opportunistic. So you're a heavy reposition. Development ultimately is really risky because there's tons of variables that go into building something from the dirt up to a physical building. So that's why development kind of fits in that bucket. But those are the four kind of that we track.
Gotcha. Okay, that makes sense. And so already we've had an incredible amount of knowledge transfer here. So this has been super useful, Taylor, to understand first off, like this monopoly analogy where we've got different investment strategies, we've got different roles in the capital stack. There's a dozen different asset classes and a few different risk profiles that real estate investors think about. So this has been really, really useful. But at the end of the day, like, how does someone think through this? And like, how does someone actually determine where they want to play within real estate investing? I'd love to hear if you have like an example of like something that you were thinking through and where you decided to play in terms of asset class, risk profile, et cetera.
Yeah. So I think that's a great point. And when I was a student, I was lucky enough to find this career path before I graduated. And a common thought that I had is, as I was pursuing a career, you're walking in your day-to-day life. And I think what's interesting is you can point to any piece of real estate, any building, and you can backtrack that specific asset to a job or a role in a professional sense, right? So when I was seeking out, which asset class I wanted to work in, I thought, what is something that I take a lot of passion in? And for me, it was building homes for people, right? And I saw the benefit, just from an aspect of benefiting people's lives, and I thought apartments would be a great way that I could impact, and ultimately that's what I did at Bridge Investment Group, was reposition older vintage assets by improving them and providing better lives for the people that live there. Another aspect of multifamily that I really admired was the opportunity to invest in an asset that has an extremely stable cash flow. People need places to live. That's always going to be what do we need in our lives? We need food, shelter, and water, right? So I ultimately that's why I chose that path.
Yeah, well, and it's honestly overlooked in terms of the impact that it can have. Like a lot of people, they say, hey, what do you need to do to have a good, successful, like positive career? Is like you go into impact investing or something like that. Or you go work at a nonprofit. But to some extent, like done the right way, you're literally putting roofs over people's heads, like at a scalable way. And obviously you're getting paid for that. And like sometimes it can be done in like a really negative way. But to some extent, that is one of the coolest careers that you can have, is like providing this intense, personal human need to people in a way that's scalable, that's desirable, that's fun, that's like affordable, hopefully. And potentially like even aesthetically pleasing or something like that. I've seen some of the deals that y'all have worked on, and some of them look pretty good too. So appreciate that insight there. Now, talk to me about what the stages of a deal look like, because there's a ton of different stuff that probably goes into, hey, I'm a student who's interested in doing a real estate deal to, hey, we got $1 billion of transactions done. So what does that look like in the in-between when you start looking at an individual real estate deal?
Yeah, no. So I think the best way to explain this is probably run through and simulate a deal that we've done recently.
Cool.
So let's just simulate, I can't point directly to the transaction, but it was somewhere here locally. I ran into someone, a month or two prior, before hearing this deal. And we went to lunch. It was interpersonal connection. We weren't even talking business. And ultimately, a few weeks later, he called me and said, "Hey, I know this high net worth individual that has owned this piece of real estate for 20 years or whatever it may be." And so the first stage of real estate is called sourcing. So you're going out and meeting with brokers, ownership groups, or whoever it may be to try to find an opportunity to have an exclusive on that deal. So the next stage, so after I met with this individual, I said, "Hey, yeah, no, I'd love to look at this. Does your friend, your high net worth individual friend, does he have any financials or a rent roll? Can he send that over and we'll model it? And if anything, we can give him a value of what we think it's worth." So the second stage is underwriting. So in underwriting, you're analyzing a deal financially, and you're trying to come to understand the market. You're trying to come to understand rent assumptions, expenses, capital costs, returns, and you're running sensitivities on that model to see, in a worst case scenario, best case scenario, is it worth it to buy this deal? So ultimately, after you're done with your underwriting, you submit an offer, which in my world, we call it a letter of intent or an LOI.
Yep.
So you send this offer, they accept it, you win the deal. This is when the real work starts, right? So the next stage, so the third stage is due diligence. So typically in real estate transactions on the acquisition side of the business, you have 30 to 90 days to kick the bricks, right? So during due diligence, you're verifying all the assumptions you made in that initial underwrite to confirm what you model is actual, right?
Yeah.
So to me, that's my favorite part, because you're really, it's the physical aspect of real estate finance. You're going on site, you're meeting with a team, you're walking every unit, you're meeting with contractors, third-party inspectors, just to ensure the numbers that you put in a model reflect reality, right? So the fourth part, or the fourth stage, is capitalizing this asset. Yeah, it's great that you have this number that you think you can purchase the asset with, but you need money to buy real estate. So the two parts of that, which we touched on briefly, you have equity and debt. So as part of that capitalization stage, you're working with lenders, you're working with equity partners, you might be fundraising these dollars, and it really is, in my opinion, the most difficult part is bringing it all together. So ultimately, once you have ensured everything that you've underwritten, everything in your due diligence is up to par, and you have all your dollars accounted for, you're going to close on this piece of real estate. And you're working with a title company, you're working with the seller to ensure it's timely. And then after you close, I know I said due diligence was the hard work. Ultimately, once you own an asset, effectuating that plan and ensuring that everything you underwrote comes to reality, asset management is the key to success in real estate. And so managing, operating that is crucial. So you're going to own that piece of real estate for 4 to 10 years, whatever it may be, and you want to hit your plan. And then the last stage is your exit. So positioning that real estate during the operating phase or the asset management phase, so that you can exit based on the millions of variables that might come up during ownership, that you can exit at where you perform it or above where you perform it, so that your return is accretive to your investors. So sorry, I know that was top down, but I wanted to give a full rundown on the different stages.
Well, and no, that's really important to understand, and I love the way that you tied it back to a specific example. But a lot of that process is very opaque again. And it's also very interesting to hear your perspectives on which part are the hardest versus the easiest. Because when I compare this to the private equity deal process that I'm most familiar with as a former PE investor, it's like the sourcing is exceptionally hard these days and getting harder because it's so competitive. There's so many people trying to do this. And then I'd also say that like the execution is probably the part where you're like working the most hours and where you're like stressed and your hair is going gray and things like that because you're working so much and then the intensity and the time frame is so fast. But also once you actually acquire the deal, doing the hard work and like saying like, was the diligence good and can we operate on the plan that we're looking for? Like that's also a very interesting and very hard skill set that kind of matches up. So
Yeah. No, that's
I'm
a great
curious,
comparison.
you talked us through the process. I don't know if there's like a specific example of like the most interesting deal you've ever worked on that you'd be willing to share. Is there something that comes to mind?
Yeah, no,
Okay, awesome.
more than happy to. So
Talk us
as you
through the most
mentioned,
interesting deal you've ever worked on, Taylor. I can't wait to see this.
all right. As you mentioned, my career at Bridge was busy. So just give it a little backstory. When I entered into the industry, I had spent a year at a smaller private equity shop, and then I transitioned to Bridge Investment Group, which ultimately at the time wasn't really a big company, but my 7 years there, it really grew, and as part of that growth came with me traveling across the country, both East Coast, West Coast, placing capital across their two fund strategies into real estate, primarily multifamily. And with that, during that period was COVID. So in the wake of COVID, the expectation was in the real estate world, oh, it's going to turn the world upside down. Rent growth is going to revert, and this is doomsday.
Yeah.
Ironically, the inverse happened. So post COVID, we saw an unprecedented increase in rent growth, primarily across the Sun Belt, which is the southernmost states in the U.S. And in the summer of 2021, we were pursuing one of the largest portfolio transactions in this given market. So north of $250 million across three assets. And as part of this transaction, there were years of preparation, years of going out to the market, interacting with brokers, ownership groups, and creating that initial relationship so that when the opportunity presented itself, we were top of the list. So that's just one note on real estate. It is 100% a relationship game. So making friends is really important.
Yeah.
So again, years prior, we're working on this deal, and we it came to market. Later stages of the bidding process, I made a phone call. And it got on the phone with the broker and said, hey, if you want surety of execution, our team is going to get it done. And, this is post-COVID. People had been pulling out of deals. It was a disaster on the brokerage front. And we just gave them confidence that, hey, we're the real deal. We're going to transact and give us the opportunity. So ultimately, we weren't the top bidder, but the seller went to us because of that confidence in our team in executing it. So ironically, this is like late spring, summer. I'm skiing out in the mountains in the spring, and I get in a ski accident 5 days before we're supposed to fly out. We're awarded the deal. We're supposed to fly out and do due diligence, and I have surgery 5 days before. I'm on a flight 5 days later.
Wow.
So I'm in this specific market for 10 days, walking the 1,200 units on a scooter in crutches. And so it ultimately, we're in COVID masks. It's 110 degrees. And I'm just pushing my scooter unit to unit, ensuring that, everything that we had in our underwriting is to par. So ultimately, what was the lesson? In the end, just bringing it to it, we closed on the deal. It was the largest transaction that I ever did at Bridge. But what's the lesson? In my opinion, deals aren't necessarily found. They're prepared for. So it's a preparation that you do before the deal hits the market, that really counts.
Mhm.
So ultimately, yeah, that's kind of, uh, in my opinion, the most memorable, for several reasons, transaction that I've been a part of. But it was very fun, and glad to be part of it.
Very cool. Well, that sounds like a model of grit almost. Like I just love that image of you in a COVID mask, rolling around on a scooter, post surgery, 110 degrees outside, like going through all the units because that's what you gotta do. And so, I'd say you're to be commended. I'm sure that that's a little bit behind the meteoric career trajectory you've had so far. And we'll come back to your career in just a bit, but I do want to spend a teensy bit more time talking through like how you think about the evaluation of these investments, how you think through about the recruiting process, because I'm sure at this point a lot of the students and folks that are hearing this are going to be interested in working in real estate investing to some extent. And so I want to talk about that recruiting process. So last question on the investing side though, like how does a real estate investor evaluate a deal? And the reason I'm asking this is I know this is probably one of the most common interview questions when you're applying for these sorts of roles. And it's one of the things that candidates probably miss up the most is they don't know how to talk about a deal. And so how does a real true-blooded real estate investor actually evaluate a real estate deal?
Yeah, more than happy to answer that. Well, how we look at it, you start broad, then you narrow it down.
Mm-hmm.
So ultimately, if you're an institutional level firm, or a nation, or your platform is focused nationwide,
Mm-hmm.
you'd start with the market, right? So we're starting broad here. You'd pick a specific market based off of demographics, local economics, and maybe you might hone into a specific submarket that you're targeting. But you have to ensure that real estate, as they say, is all about location, 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 right?
Mm-hmm.
So it's vetting out the market. The next thing that you have to ensure is that the basis, or whatever they're marketing that price for, whatever you're purchasing the asset for, it has to make sense, right?
Mm-hmm.
That dollar amount on a price per unit or a price per square foot, it has to make sense. And not only that, comparatively to other transactions that might happen, that dollar amount has to make sense for your investors. So ensuring the price point, and this is where the underwriting comes in, that price point translates to returns that meet a hurdle requirement for your investors. So basis is the next big part of the equation. The third is a business plan, and this kind of goes hand in hand with a basis, is your business plan, which should be reflected in how you underwrite deals, has to reflect reality. Okay.
Mm-hmm.
So what rent assumptions are you assuming in years 1, 2, 3, 4, 5? What variables as far as forward occupancy assumptions are you keying in? You have to be able to justify every input that you're putting in your model. The fourth thing is being able to stress test risk. So in real estate, I think I mentioned it before, but we like to simulate doomsday scenarios. So in a worst case scenario, what do returns look like?
Yeah.
In a best case scenario, what do returns look like? So it's all pulling levers in your model and simulating those different scenarios to determine the relative risk for a deal. So the last aspect of a deal, because ultimately all that a real estate pursuit is it's a discounted cash flow model, right? So you're purchasing the asset for the opportunity for forward, hopefully guaranteed future cash flow. And then on the back end of that, your terminal value is this exit, right?
Mm-hmm.
So that's, what is the property going to be worth in 5 years? What assumptions do I need to make to figure out that value? So that's a fifth and last step of kind of how we evaluate real estate,
Yeah.
is what environment am I selling in? But does that make sense?
Yeah, that makes a ton of sense, and you laid it out very, very clearly. So you've got like the market, the basis, the plan, the risk, the exit. Like you've got to consider all these things. And it's really funny. I almost feel like I'm like in an uncanny valley here where I'm like, that sounds very similar to how I think about PE deals, but all of the terms are just like slightly different and all of the vocab is like slightly different. It's funny to me how real estate has this entirely different set of jargon. And so you have like these different sets of words like core and core plus versus I would just call it like, stable versus cyclical or risky or something like
Yeah.
that. Um,
I'm a firm believer that different industries in finance create their own jargon to almost butt out other professionals from
yep.
entering their space. So it really is to your point. We're speaking the same language. They've just interchanged the words and gave them
Mhm.
different names. So
Well,
so
and
yeah.
you're doing the noble work of breaking down those barriers right now. So
I hope I'm
keep
doing
watching. I'm
that.
sure we're
Yeah.
gonna get a ton of little values here in terms of the different vocabulary and insider secrets and things like that. And so let's turn to the insider secrets in terms of like building a career in real estate investing. So we've talked about like the what of real estate investing. Now I want to talk about the why and the how a little bit. And so just to start us out, what do you think are the advantages of building a career in real estate investing?
Yeah, no, I think for me, these benefits, I didn't realize them until retroactively. So luckily enough, I got into a career path that I enjoyed
Mm-hmm.
doing. And this is ultimately something, if a student's talking to me, I really want to emphasize these advantages because these are more of the qualitative aspects of pursuing a career like mine. But the first, I love the entrepreneurial spirit and the
Mm-hmm.
benefit you have to think like an owner. Oftentimes, you're
Mm-hmm.
siloed as an analyst working on your deal yourself, and you really have to put an owner hat on.
Mm-hmm.
And so I really like that aspect and the application of that. Real estate, I think it's well known. You can apply it in your personal life. You've heard success stories of these real estate moguls that
Yes.
started with one unit and it turned to two and it turned to four
Yep.
and all of a sudden they own 10,000 units across the US. It
Mm-hmm.
really is a great pathway if you do it right and you time the market right to create
Mm-hmm.
generational wealth. So that was another advantage that I saw. Um, another one is travel and experiencing different cities, different cultures. I think I worked in 26 different states, and I
26
spent
different states. Whoa, back up.
yeah
You got to work in 26 different states in your real estate career?
yeah yeah.
That sounds fun.
So
That sounds really fun.
so yeah, over 7 years, I was consistently like the platinum
Yeah.
Delta member, and we're on flights. But it's cool because you're
Yeah.
interacting with site teams, you're interacting with
Mm-hmm.
people from different backgrounds, and it
Mm-hmm.
comes to form you as a person as well, which I
Mm-hmm.
really enjoyed.
Quick side
Um,
note on that, real quick.
yeah,
I love to travel. I think that sounds like a blast for students or folks who are looking to break into real estate that don't want to travel as much. Is that possible too, or is it just particularly this job that was like super demanding on a travel schedule?
it really depends. I think my experience at Bridge was unique in that we were in the midst of a growth stage.
Mm-hmm.
So I would say that's kind of on the higher end of
Mm-hmm.
travel. But if you are working at a, call it, institutional level firm, you're going to travel and see your assets. It's very likely if you're working in New York or San Francisco, Chicago, wherever these, call it, top 15 PEREs are located, chances are the assets you own aren't in New York, San Francisco, or Chicago. So you're going to
Mm-hmm.
be hopping on a plane. You're going to be visiting the assets because that's how you live and breathe the business is traveling and physically seeing them. So definitely, there's quite a bit of travel. I would say as an analyst, you're not doing as much, but if you transition into the associate, vice president, there's
Mm-hmm.
a significant amount of travel. So
Gotcha. Okay, very interesting. And the pros and cons, you get a little bit of the Delta rewards or whatever. Go take a vacation
Yeah.
on the house or whatever. But any other
Yeah.
sort of
And
pieces that you really recommend about a career in real estate investing beyond the wealth and the travel and that sort of stuff?
yeah, no, I think that actually leads, I mean, the flight benefits leads into to my next point, which is work-life balance. Um, Deal cycles in real estate, I mean, especially if you're kind of in the development space, they're long, right?
Hmm.
So the ebb and flow of my day to day gives me the benefit to take a step back and step away when there's not as much deal flow. So that's what I really like you're not always in control, but during down seasons, you can, focus on family or focus on your
Hmm.
personal life. So that's something that I really like. And the last thing I'll mention is the fact that a career in real estate finance is very intellectually stimulating.
Hmm.
And the reason being is, as I mentioned kind of in our intro, the rules are constantly changing.
Yeah.
Municipalities are changing laws. Migration, who knows how to track migration? People are moving in cities, out of cities. And being on top of it and being able to track and estimate
Hmm.
where the next gold mine is, it's really important to do your research and be familiar with the target markets that you're placing in. So ultimately, that's why I really like it. Is every day is different, and every day comes with a new challenge.
Yeah. Yeah, yeah. The intellectual stimulation is absolutely what kept me in finance for as long as I stayed in the industry. Is it was so fun to me to get to like zoom into a specific business and a specific subsector within the tech industry that I invested in and get to learn like how does database software work, or get to learn like how does a space company like a rocket or satellite provider work, and just like digging into these pieces. And I imagine it's the same thing. You're like, how does that building work, how does that building work, like multifamily,
Yeah.
interesting, ski resort, fun. And so the intellectual stimulation, you're getting me curious. I'm probably not going to switch careers at this point, but like I'm tempted. Uh,
Yeah. Yeah.
so let's talk about the how. That's the why. How? And so, what does the recruiting process look like for these sort of real estate professions? And as an interviewer over the last decade here, like what do you evaluate candidates on?
Yeah. Um, so as a student, I think it's a pretty similar process to an IB track or a consulting track as
Hmm.
far as the needed requirements to get in the door. So your freshman year, maybe you're interacting with local real estate professionals. You're kind of getting a general understanding of the jargon and in the industry, and you're building a basic foundation in
Hmm.
both finance and modeling. Your sophomore year, you really want to target to get a internship, and I would probably encourage you to do it somewhere local. In any and all major cities, there's typically a family office or a regional real estate player that will offer up an internship, whether it's paid or unpaid. I'd really encourage in your sophomore year to take advantage of that. One, because it's a notch on your resume, and
Hmm.
two, it really is a test if you like that specific asset class or strategy that you're interning in.
Hmm.
Your junior year, it's really crucial to build off of that experience that you gained at your
Hmm.
sophomore internship to land a what I would call an institutional level internship.
Hmm.
And in most cases, those are going to be in your major
Hmm.
gateway cities.
Yep.
Um, and so the reason why I really encourage students, no matter where they end up in real estate, to land that junior internship at a large firm is because you can always downsize. You can always go to that local family office that maybe you interned at as a sophomore. But getting that institutional credibility and experience is crucial, because ultimately you learn how the the kids on the playground, the big kids do it, and then you can go do it at a small shop. So I'd really encourage to capitalize your junior summer to get a call it institutional level internship. So senior year, this is where you got to kind of pick and choose, right? Because it's not like IB or consulting or even, corporate finance where you want to end up at a huge firm. There's people at these local family office shops that make as much money and have as just as successful as a career in their positions compared to somebody that goes to a Blackstone, BlackRock, Starwood, Bridge Investment Group. So you really have to choose one pathway. Do you want to be a small player, regional developer, regional acquisitions guy, or do you want to go work a very specialized, very niche position at a larger shop? And there's nothing wrong with the dual track there. I would just encourage by your senior year, you want to either know, am I going to be working at a big shop or am I going to be working at a smaller shop? But that in short is kind of what I would encourage students to do progressively through their 4 years in college.
Yeah. That makes a lot of sense in terms of like the progression. And again, kind of similar to like investment banking, which I'm more familiar with, where it's like you've got to get some internships and local small scale things in the freshman and sophomore year, and then recruit for that junior year big internship that hopefully converts for the full time. And so in terms of like the things that students should prepare at, like in investment banking and private equity, it's a lot of times it's like the networking, the behaviorals, the technicals. What are the things that most students don't realize they should be doing to prepare for real estate interviews specifically?
Yeah. So the first thing, technical ability is table stakes. So you have to be able to come to understand Excel and have a proficiency in Excel and be able to build a model. There's certain resources. Adventures in Commercial Real Estate is a great platform that gives dozens of Excel modeling classes that have videos paired with that model that I would encourage students to do. But you have to be able to build and understand a model of whatever asset class or strategy that you're deciding to pursue. So again, like I said, that's table stakes.
Yep.
The second is logic or judgment. Oftentimes, like I said, the rules are changing. So when I'm looking at hiring a potential analyst, I want to determine, can they think for themselves? Can they communicate effectively? Do they know when to communicate? So that's a second thing. And the third item that I would encourage students to really focus on is find yourself working on your soft skills, because being a good culture fit is key. Real estate is a social science, and it is very relationship driven. Yeah. So finding an analyst that fits well with your brand or your culture is crucial. So I kind of did those three stages: technical ability, judgment, or logic and communication. You could probably bundle those three together. And the last one is a culture fit. But yeah.
Well, give me a little more context on the judgment side of things. I know that you talked about this already a little bit, but that's, in my experience, often one of the very hardest parts for students to develop. And for professionals trying to break into like investing jobs, is to put in that investing mindset hat. And just to like share example, like when I was in private equity as an interviewer trying to get, analysts and interns and associates on the team, a lot of the times we'd give them like a case study. And so this would be like a modeling test, and we give them a sim, like a document, and they have to analyze it. And it's remarkable to me how many people would just like read through it and like sort of regurgitate their thoughts, as opposed to having like a structured investor mindset. And so how did you develop that? And how would you recommend that students or other people trying to break into real estate develop their investor judgment?
You got to think like an owner. I talk to my team. They probably get sick of me, but we run through real life scenarios and apply that. Okay, you can pay somebody, let's say a manager at one of your properties. You can pay them 10, 15% more, and that translates to, 3 or 4 more leases. How does that affect your top line? Oh, you're going to generate, $50,000 on your bottom line for paying a manager, 10, 15K more. Would you do that? The answer is yes. But thinking through that process of, okay, if I own this real estate, how would I be calling the shots? And ultimately, I think that's something that we're getting away from with the with AI and ChatGPT. You kind of ask, AI, what should I do? But ultimately, this is why real estate is so cool, is because it's so imperfect. It's so asymmetrical that there isn't an efficient way to do things. You just have to find out how to do it a little bit more efficiently than the guy next to you, right? Yeah. So that's ultimately what I would say, is just put on your ownership hat,
Yeah, exactly. I love that. More efficiently than the guy next to you. Interesting. And so we've talked a lot about a lot of different things in real estate. So we talked about like what real estate is, like how to think about the different asset classes, this incredibly complex game of Monopoly. We talked about how you basically chose the segments within it that you're most interested in. We talked about the ways that can create generational wealth, and that there's some balance to it, and travel and experiences. And so some really incredible things, and how to actually get there. Now, I want to transition a little bit to our next chapter here, Taylor, which is to talk about your story specifically and how you managed to make that happen. So we know theoretically like how you get into a real estate job and what that looks like, but let's apply it back to you. So starting way back when you were in college, like what did you think your career would look like? Did you realize that you were going to like blitz your way up to like the highest levels of real estate investing, or were you starting somewhere else?
No, and the saga of Taylor's life is an interesting one. In my own regard, I'm a success story just because of where I was when I was 19 years old. So rewind the clock. I'm 19. I won't go through the circumstances of how I ended up here, but I was working in a warehouse. Again, somehow I always find myself in 110-degree weather, but this is in Phoenix, Arizona, in a warehouse. And I'm packaging candy bars and chips for this vending corporation, this vending company. And the owner of this company, who ultimately became one of my mentors, he approached me one day. I'm 3 or 4 months into the job, and people are on their smoke breakout, and he pulls me aside and he says, "Taylor, you seem unhappy." And I'm like, "Yeah, I'm unhappy. I'm working in a warehouse. I'm 19 years old. I'm not enrolled in college. Like, yeah, I should be unhappy now." And he points out, and he kind of, he alludes to my dad, who is an orthodontist. And he points out, I'm going to compare and contrast your dad's experience and my experience in my career. And maybe it'll give you some enlightenment on what you should do with your life. So he points to my dad and he says, "Your dad, in order to make money, he has to have his hands in people's mouths all day." That's how he phrased it. And then he says, I built this business where I can go to my beach house in Coronado and I'm still making money. So while your dad needs to have his hands in his mouth in his 9 to 5 to make money, I can go spend a month with my family in Coronado and I make the same amount. And what really struck me is he said passive income doesn't clock in, right? So he encouraged me to get to a point where you don't have to clock in and you're still making money. And so ultimately that started, getting the wheels churning. 19-year-old Taylor, he's working in a warehouse. I need to get into business. And so that transition, ultimately I got into school, luckily enough, a good school, right, at BYU. And at BYU, they put you kind of in these different tracks. And IB is the most prestigious, as you know, Max, is the most prestigious. And it ultimately, at the time I was there, was the most popular club. I got in the club and I realized, I was very driven, but coming from a small farm town in southern Arizona, I didn't want to go live in a big city. So I went to the club for a few months and kind of pushed it to the side. Yeah. Said, okay, corporate finance is for me. So a week before my my junior summer, I landed an internship in Southern California, in Orange County.
Hmm.
So I hop in my truck, don't have a place to stay, and I spent the first 2 3 weeks homeless in a truck on the beach while I start my first. I was at a Fortune 15 pharmaceutical company, and I'm living, in a truck for my first few weeks there.
Oh my
And so
gosh.
that was my experience. And I understand you have a similar experience, Max, living in a car. So I'm
You
glad
gotta
that
stay scrappy, but like, oh my gosh, like that's something else that I'm just picturing you like in a truck, on the beach, watching the sunset on your laptop, like hot spotting, like into like your corporate finance role at like this massive Fortune 15 company. That's crazy. That's like some real
yeah.
hustle. That's some real hustle. And one of the things I've really enjoyed about this conversation, Taylor, in addition to like your storytelling ability, is the way that like you break things down clearly, and then B, it's just very, very clear that like you have a lot of drive, which is something that's so hard to teach. Like when I'm working with students, like sometimes they're not like the sharpest tool in the shed. Sometimes they're brilliant. Sometimes they go to a good school. Sometimes they go to a crappy school. Sometimes they have a great GPA. Sometimes they have a terrible GPA. And I can usually fix those things such that they can succeed in interviews in finance. But if they don't want to, if they're not the sort of person who's willing to go, sleep in there on the beach and like get that internship, there's not a lot I can do. And I just really love that like you had that, and I think that's been like the driving mentality that's made you so successful, and like your ability to like climb the ranks so effectively and get so much capital deployed in real estate has been a lot of that. But really cool story.
You're making me blush. You said too much. But yeah, so ultimately just fast forwarding through the rest, Taylor's in a truck, living his best life on the beach, surfing every day. But I didn't love corporate finance. I'll be
Yeah.
honest. Like I grew up, like I said, I grew up in a really rural area. I was working with my hands a lot, doing construction jobs. I love the tangible, physical aspect of real estate, and I'm glad I fell into that. So ultimately, came home from my corporate finance experience, and I dove headfirst into gaining experience and interacting with real estate professionals locally to find a position in real estate. And my experience was a few years of just taste testing different, I did development for a little bit. I worked at a smaller shop. I transitioned to bridge, and ultimately that's what I'd encourage your students to do is just act. I think there was analysis paralysis to an extent for me my sophomore junior year, and ultimately I just needed to act, because it wasn't until I was sleeping in a truck on the beach working a job that I didn't like that
Yeah.
I realized what I wanted to do. So
Yeah.
that's kind of my tidbit there.
Yeah, yeah, yeah. Like if you are trying to get somewhere, you've got to go somewhere, and then you can course correct from there. And so one of my professors at Stanford GSB, he's this famous founder of a really really successful investing firm, and he always says do experiments. Like just do teensy little experiments to learn if you're interested in something. And so instead of sitting around being like, oh, I probably like corporate finance, I'm just gonna like assume that I'm gonna get a job in corporate finance. That'll be great. Take an experiment. So like, what's the first thing you can do? Well, the easiest thing you can do is go and Google about corporate finance, or spend some time with chat, like what is corporate finance? Then get a little more intense. If you like that, then go talk with someone and like get on the phone with them. And then if you like that, get on the phone with a few more people and maybe do like a remote project for corporate finance. Take a class for corporate finance. If that goes well, then do the internship. And then luckily you did that as an internship instead of as a full-time job where you wake up 10 years later and you're like, I really hate this. It was an internship, and so it was a test, and so you could sort of iterate. And so I really like that iterative mentality that this professor recommends, and it sounds like what you were testing as well. And so when did real estate finance specifically click for you as something that you wanted to build your career around?
It was when I started making money on my own investments, being completely frank.
Oh,
So I'm 24 years old, and maybe you can allude or guess this, but yeah, I was pretty scrappy coming out of college, and I'm working at Bridge, which is this behemoth, and it's starting to roll. And I eat PB&Js and ramen for 6 months, and I finally had enough money, and I barely qualified to buy my first home.
Yeah.
So I did that with the intent. I'm a single bachelor, and I bought a 6-bedroom house, and I rented all the rooms out to young professionals, and I cash flowed. I paid my mortgage and cash flowed some. And in the first year or two, the home appreciated around 30-40%.
Wow.
So I thought I was printing money, which the appreciation to an extent, yes. But the lesson from that, I don't think you can't bank on appreciation. You can't control the market. But what I really liked about that was, before I bought the home, before I did all that, I was making a plan, right? I was eating PB&Js, I was eating ramen, and I modeled this out. I modeled out a single family home acquisition. And I said, okay, how many rooms can I fill? Okay, look, where's a good house with, a location where young professionals would live? So I had, this thought process of, okay, how can I make money off of this investment in a home? So I think that's where it really clicked, and that's what excited me. And that's where, I started to snowball into all these deals at Bridge. Was my excitement was spurred by the application in my personal life. And so ultimately, like, the next 4 or 5 years at Bridge was wildfire, and traveled the entire country. I mean, it was incredible. So I think that's when I was 24 years old. That was probably the moment that it clicked for me.
Yeah, that's really cool, and I love this idea and this image again of you eating ramen, eating PBJs, and like buying a 6-bedroom house. Like those ideas don't usually mesh up in a normal person's brain, but a normal person isn't building generational wealth in real estate. And so there's obviously some secret sauce going on here. And so I'm curious, I want to get into like how you had this like incredible rise within real estate, because you got promoted exceptionally quickly. And so let's talk through some of the skills that you had developed. And in particular, let's talk about the technical skills. And so how did you master the technical skills necessary to operate at a high level in these real estate acquisitions?
I think we alluded to it in our advice to students on what they should work on as far as the interview process, but financial modeling is so key. No two deals in real estate are the same. So being able to be creative and create models that are add-ons or tools to integrate in whatever your master model is crucial, especially where I currently work at a smaller shop. We utilize that pretty frequently. So modeling is key. Communication. I had a boss that said, if you can't convey it in 2 lines in an email, I don't want you to send me that email. Wow. So being able to understand, maybe you're working on contracts or legal documents or whatever it may be, being able to explain, a 20-page document in 2 sentences effectively is crucial. So communication is key. Reading comprehension, talking about documents and contracts, and some lender documents that we have, they're hundreds of pages. Being able to read them quickly and digest that information is crucial. A lot of people assume finance is all numbers. I'm sure you know this. It is not. It's being able to read and digest as well. So reading comprehension is crucial.
Yeah.
Logic. We talked about this, just general judgment and being able to use logic in your day-to-day was crucial. As we were growing at Bridge, there were, it was, this is during COVID era. So you can imagine the largest wrench thrown in the mix was in COVID, and being able to find creative solutions on how we adapted our strategy to invest effectively in that environment was crucial. So being able to use logic is key. So that's, I don't know, in a nutshell, those are kind of the 4 that I would point out.
Mm-hmm. Gotcha. Okay. That makes a ton of sense in terms of the ability to get the technical skills, which, as you mentioned, are table stakes for the interview, but also so important to actually doing good deals down the line. And so that makes a lot of sense. The other piece that's very successful, or that's very necessary for being successful in real estate investing, is like the conviction that you have behind deals. And so when your own money was on the line on these individual properties that you were investing in, or when the firm's money and your job were on the line with the institutional capital you were deploying, how did you develop conviction in your real estate underwriting?
Yeah. Well, I'll illustrate this through an experience that I had. So the conviction is real when you understand the consequences of the assumptions you're making. All right. So
Yep.
rewind the clock probably 5, 6 years ago, we're pursuing a deal in Northern California. There was a rent component that I thought at the time I had messed up. So it was a 3% impact to year one rent, right? So you're like, okay, 3%, it's not bad, right? But you trend those rents over 5 years, because that's what we do in real estate. Trend those rents, it equates to $120,000 miss on your year 5 NOI. And that, if you cap that, this is during a period of 4% cap rates, which is a 25x multiple if you're just, running the math. That translates to a $3 million miss. So Taylor's mistake on a 3% miss on rent growth translates to a $3 million miss on value. So for me, I couldn't even quantify $3 million because, I wasn't making that kind of money. So conviction is key when you realize that those misses are real, and you're not only impacting the firm, you're impacting the investors, which at the time, a lot of pension funds were invested in our platform. So, I'm affecting teacher salary and firefighter salaries and all that. And so that really hit me hard. And ultimately it wasn't a mistake. It was a mistake of me analyzing that. So in reality, it turned out fine, but just being able to stomach and conceptualize the impact that you have as a real estate investor is really crucial. So Max, you might ask, how do we mitigate that? It goes back to best and worst case scenarios. In real estate, we view doomsday. You're underwriting a worst case scenario, best case scenario, and getting reps. Even as students, I encourage them to simulate an acquisition. Look at a piece of property and pretend like you're buying it. What is it worth, right? And then the last thing is just discipline. Don't just glass over assumptions. Being able to justify every number that you input in a model is crucial, and being able to back that with actuality when you actually visit the physical real estate is crucial in our field.
Gotcha. That makes a ton of sense. And I love the way that you describe that. Like, when you're building an Excel model and you type in 4% rent growth or 3% rent growth or something like that, it's hard to understand, that actually has an impact. And you see some number change, it starts to just look fake. You're like, oh, there's a lot of commas there. But when you think about it, you're like, no, I'm impacting millions of dollars here. And then you zoom out and you're like, okay, outside of this crazy bubble of finance, most people in their entire lives will earn a few $1,000,000 in the US. And globally, it's probably a fraction of that. And so the single input that you're putting in your spreadsheet right there has a kind of a tremendous amount of impact. And I think that's part of why people like finance careers so much, is because there is that capacity for impact. But you're going to make a lot of mistakes unless you understand that and kind of feel that, and then translate that into the checks and the balances and the logic and the judgment and careful thinking that you need to succeed there.
Well said. Yeah.
So I really love that. And I want to be sensitive to our time here, Taylor, because we've been having a really good conversation, but we haven't gotten yet to what I think is perhaps the most interesting part of your career, other than the impact that you've had and the capital you've deployed, which is the accelerated growth. And so correct me if I'm wrong here, but your path upwards, from analyst onwards, has been exceptionally fast. And so I'd love to hear your thoughts on what the normal career trajectory looks like in terms of how many years to spend at each of these levels. But in investment banking, it's you spend 2 to 3 years as an analyst, 2 to 4 years as an associate, and then you spend 3 to 5 years as a VP, a few years as a principal or something like that. and you, about 7 years in, are already at the director level. How'd you do it?
Oh, I think it's a combination of hard work and luck. In real estate, you have a comparable track. So you spend 1 to 2 to 3 years as an analyst, like you said, 2 to 3 years associate. You add on 3 years as a VP, you're close to a decade. Yeah, and fortunately, I think it was a concoction of where I was situationally and the firm that I was at. But my experience over the 7 years probably translated to someone else's experience for 10 years at another firm, just because of the amount of deals that we were doing and the exposure that I had to real estate. So I think I won't accredit it to myself alone. I think it was 100% just the place I was at. But ultimately, if I have to give any advice, titles ultimately don't mean much. In my opinion, I think it's just how your boss or your manager views you is really crucial in how you work with your team. Because I think it was the others around me that lifted me up. And fortunately enough, there was 7 analysts, or 6 or 7 analysts when I started at Bridge. Now they have probably close to 35, 40. So as the team grew, I grew with the firm. So it's being able to work with others and kind of build your team. That's ultimately what I point to as to how I move through the ranks so quickly.
That's awesome. Yeah. Wow. Well, congratulations on that. And to some extent, like you say, experience trajectory boosts can be because you're excellent, because the team you're on is excellent, or just because you get so many reps so quickly. And it sounds like it was a little bit of all those things where you were just getting 10 years of work crammed into 7 or something like that, and getting that accelerated trajectory as a result of it. And so I'm curious a little bit about how you chose the firms that you joined. And we can get into as much detail as you'd like or not here with regard to the places that you've built real estate acumen. But as an outsider to the industry, I think it's really important to get kind of an inside peek in terms of like what goes into the candidate selection process for the sort of firms that you'd like to look for, and how you evaluate the job potential and the career acceleration trajectory of working at different firms. And so tell me a little bit about how you chose Bridge Investment Group and how you chose Low Property Group and what each of those are known for.
Yeah, I think we alluded to this kind of when we're giving advice to students earlier on in the podcast. But I think for me, Bridge, I was drawn to Bridge because of the size and what they were advertising to me as far as their growth trajectory. And so I wanted to work at a big shop and kind of focused nationally. And then I spent, 7 years doing that. And as you mentioned, I grew really fast, and it got to the point where, I was managing people and I felt somewhat stunted. So, that transition to my current position was driven off of a desire to learn more. So ultimately, my transition to Low was a lateral move to feel that entrepreneurial spirit again, and to dive headfirst into something where I was learning every day again. So,
yeah, I love that. That makes a ton of sense, and I'm glad that you were able to find a place that was like really accelerating your trajectory and getting a lot of those deals, and that you've been able to make more informed decisions about your own preferences later on. And it's kind of funny to me, like how much you learn about like what's a good fit for you over time. And you can get a lot of that from networking, and I encourage students to do that. Like you got to go and talk with as many different people at the Lows of the world and the Bridges of the world, so you can get a sense for what you like. But at the end of the day, it kind of comes down to just like what happens when you're actually working there. And
right.
Do you click? Do you enjoy the strategy? Do you get along with your manager? All those sorts of things. And so another thing that I'm really curious about, as you've built this career and you're clearly investing for the future in real estate, like you've built a decade-long career so far, stemming back to your first deal that you just did with a 6-bedroom house on your own money. And so how have you been able to like build a long-term reputation and relationship set in this industry? Because as you were talking about, this is a relationships industry, and the sourcing is one of the most important components of it. And so, how do you think about building long-term relationships with brokers, with owners, and capital partners in real estate?
I think it's essential. We mentioned earlier that it's a relationship game, and
Mhm.
your reputation means everything. So at our current firm, we prioritize people over real estate. It really is the people that make or break a deal, and you don't know who's looking. There's oftentimes in my career where the lines are grayed, and you have a choice between doing what's right and what's accretive. And
Mhm.
ultimately, I always chose what was right. And I think, at times there might not have been people watching, but I think it's crucial to keep that reputation, and be able to work with people that you want to work with. And so yeah, ultimately, I think it's more important than the numbers is being able to convey yourself in a manner that reflects how the business that you're promoting should be reflected. So.
Mhm. Yeah, I love that. Well, Taylor, I do need to make sure that we get to talk a little bit about the future of real estate investing before we wrap up here. And we got to talk about some of the trends and some of the interesting things going on. Because as I was alluding to at the very beginning, like there's been a huge focus on real estate specifically right now, in part because of the relationship with AI, in part due to the growth curves of our economy as a whole, and like the trends towards onshoring versus offshoring, and the tariffs and trade wars and things like that. And so a lot of stuff that we've got to talk about. But I'm curious to start out by talking about your investment framework. And so, over the last several years, as interest rates and capital markets have shifted, how has your investment framework evolved?
Fundamentally, everything. You kind of mentioned the current events in our market now. The last 5 years have been brutal, with COVID and interest rate reversion. When I started my career, cap rates were in the mid fives. They came down to sub three, which is north of a 25x multiple, if for those that are unfamiliar with
Mhm.
cap rates. And then now, with interest rates reverting, they're back up to the mid fives, and being able to navigate that is crucial. We had mentioned before, real estate's an ever changing industry, but yeah, I think ultimately, we've talked about it. It's being nimble enough to come to understand the market, and being able to adjust what needs to be adjusted to make your investment make sense in the environment that you're placing in. So.
Mhm. Yeah, yeah, absolutely. And so I think that we've probably seen a bunch of trends changing over the last half dozen years that you've been in the industry. We had, as you were mentioning, the crazy era of COVID, where there was like a growth oriented underwriting environment, and the interest rates were super low. And then there was a little bit of a pullback, and then we've had the second Trump administration and some really interesting developments there that have created a unique environment over the last year or two. And so um, I think I've heard you say that like at this point we're kind of in a flight to quality stage in real estate investing,
Mhm.
and that's a really interesting shift versus historically. I would say that wouldn't necessarily have been the case, but I've loved your perspectives on that. And so, what do you think is driving some of these things? Like, what are the trends you're seeing in real estate? And I'm curious, given your specialization in the Intermountain West and the Rockies, like what are the trends going on there?
Yeah, I love that you pointed out flight to quality.
Hmm.
And I'll just run through kind of
Hmm.
short story on what has happened in real estate over the last few years. So there are several groups that were capitalizing on a crazy amount of rent growth that came from 2020 to, well, it was really like 2019 to 2021. So a lot of syndications got over their skis, levered up. So, call it 70, 80% LTV on a lot of these deals. assuming all this forward rent growth, because they wouldn't invest in the deal unless they thought that they would make money, tacked on floating rate debt, and then all of a sudden the interest rates spiked, right? So what happened going forward, especially in a scenario where you have floating rate debt, is they're underwater. And not only that, underwater as it relates to their mortgage payment, but not only that is values over 6 months reverted close to 25-30%, depending on which market you're looking at. So, so the institutional players are fine because they had pent up capital and liquidity that they could kind of stomach the next few years, and they're kind of kicking the can. The syndications, on the other hand, we're seeing an environment where banks are taking back a lot of deals, and in most cases, they're owning and operating them themselves. But how that's affected capital markets is there's one, constrained leverage, right? And I mentioned they're targeting 70 to 80%. Now it's like leverage is a double-edged sword. So you might not want to lever up. Now it's more like the 50 to 65 range is where deals are typically done. Agency financing is pulled back as far as max proceeds that they're allowed to give. And ultimately, this flight to quality that you had mentioned is a trend that we're seeing amongst the different players, where you're seeking newer vintage, you're seeking nicer product in a better location because it's a more conservative effort in placing in an unknown market. So I hope that gives a general broad understanding and insight to the current market today, but it's tough. I mean, every day is a battle in finding deals and operating deals. So, but I'm just excited to be a part of it.
Yeah. Well, so maybe the last thing that we can talk about in this section around like trends before we get to our little closing out here is I want to talk about AI. And I apologize. You knew it was going to happen. I knew it was going to happen. We just have to talk a little bit about its impact on real estate, just because it's been such a focal point in the news and in the industry and in real estate and in technology right now. And so what is the impact of AI on real estate in today's market?
I don't think AI will impact real estate jobs as much as other industries in finance. And I think it's more so pointed towards the asymmetry that we see in my field. Like I mentioned, no two pieces of real estate are the same. So there's always going to be that human advantage in the negotiation part of it, and then the capital raising, and then strategic decision making relative to that awkward piece of the puzzle that you're purchasing. But I do feel like AI is going to automate a lot of the processes in real estate that are redundant. So underwriting is going to be much quicker. In the way you can find or track or source deals is going to be a lot more accessible. So I do feel like those individuals that can learn and come to understand AI and all the tools that come with that will have a strategic advantage in their pursuit of finding the right deal. I don't think you're ever going to take the human element out of it. At least not for a long time.
Gotcha. Okay. Well, that's encouraging to hear. And honestly, a little bit of a contrarian take relative to a lot of folks that I've talked with recently, had conversations with in finance. But at the end of the day, like you're saying, because these are so bespoke and the asset classes are in some ways a lot less standardized, I can see why there'd be a little bit more room for judgment as opposed to like big data synthesis. So with that, Taylor, like we've covered a ton of ground today. We start out by talking about the world's most complex game, Monopoly, all the different asset classes, capital stack roles, all the different types of risk profiles you can take in finance within real estate. We talked about how you evaluate real estate deals and what that cycle looks like from sourcing to execution to maintenance and exits. We talked about how to recruit for these and why you might want to recruit for them, and the wealth and the work-life balance and the intellectual stimulation of these careers, and how you managed to climb your way from a warehouse worker to sleeping on a beach, working at a corporate finance job, to ultimately having this rocket ship trajectory within real estate investing and the billions of dollars that you've been able to deploy. And so with all of that in tow, I have a few closing questions that I like to rapid fire ask everyone who comes on.
Let's do it. Yeah, okay. I'm ready.
Great. Okay, so first off, what's the highest ROI habit, technique, or routine that you picked up in your finance career that you still use today?
Learn something new every day. You got to continue growing in order to be successful in this life, and I'll stand by that.
I love that. What did you learn today, by the way?
I learned that waking up at 5 and hopping on a podcast with Max Adams is an incredible way to start your day. So I'm really grateful that you brought me on. So
good. You're too kind. And thank you for the early hour here. Now, second quick question we have to ask is, so if we looked at your calendar and your bank/credit card statement from last month, what would it say you actually value outside of real estate investing?
Yeah. So my wife and I share finances, so it would show that she values me. Cause she treats me too well, but I think for me, it's family. We spend a lot of time and money to I don't know, make each other happy. So I think it would reflect kind of, we care for each other. Yeah. Which is ultimately why we're doing all this. Right. So yeah.
You got to get that good family wealth, as you're saying, the intergenerational real estate.
I don't know about that, but yeah.
Just kidding. Okay. And then last but not least, I want to copy a question from how I built this. You've been very humble throughout this entire conversation. You've really pitched a lot of your success as luck, which is understandable to an extent. But I'm curious, like, ultimately, how much of your success do you think is due to your hard work and your skill and your intelligence and your grit and your hustle? And how much do you think is due to luck?
I honestly think I can't give myself too much credit. So it's probably 50-50. I think circumstantially, I was lucky enough to end up in a position where I had so many resources with mentors and a job that really pushed me and allowed me to travel and see so many different things. So I can't take credit to all of it. So it really is 50-50. The other 50%, I'm not the smartest guy on the block. I just really credit my hard work to where I've got today. So just being able to dig in and work hard day in, day out, I think that's really the combination of 50% luck, 50% hard work got me to where I am today.
Awesome. Well, Taylor, with that, thank you so much for taking the time to talk. Yeah, you've had a really interesting career, and I think you've helped us pull back the curtains a little bit on an extremely opaque and yet extremely interesting, lucrative, and stimulating part of finance, which is real estate investing. And so anyone, any of our students at Wall Street Mastermind who have looked at this and are looking to break into real estate careers, I'm sure will have learned a ton going through this. And so thank you so much for helping us break that apart. And I hope that you have a great rest of your real estate investing day and go get some billion-dollar deals done.
Thanks, Max. Thanks for having me. Really appreciate it.